You're listening to AI Prism from Seoul Economic Daily.
It's Wednesday, May 13th. I'd like to share some thoughts about global investor. We are looking at a really contradictory macro environment today, starting with this massive spike in geopolitical risk.
Yeah, the rhetoric is getting pretty extreme. I mean, Trump just put the U.S.-Iran ceasefire survival probability at like 1%.
1%, I mean, that's basically zero.
Right, exactly. And he's actively reviewing a resumption of Project Freedom. In response, you've got Iran's parliament reviewing a move to enrich their uranium to 90%, which is weapons grade.
But the public rhetoric is only half the story, right? There's this hidden escalation going on.
Yeah, the UAE secretly attacked Iranian refinery facilities on Lavon Island,
Which obviously drew immediate retaliation.
Exactly. And this means the Gulf states entering the conflict expands the perimeter. That is a risk completely underpriced in current oil futures.
Right, because this isn't a localized fire anymore. It's spreading to the neighbors' supply lines. And WTI crude jumped to 99 USD per barrel on this.
And it's not coming down soon. JP Morgan forecasts that crude will actually remain in the low 100 USD range for most of 2026.
So with oil skyrocketing, you'd think equities would suffer, but U.S. equities are sitting at all-time highs. They're completely decoupled.
Well, yeah, and the sole reason for that is semiconductors. I mean, the Philadelphia SOX index is up a massive 70.56% year to date.
It's incredible. And the driver there is Agent AI, right?
Yeah, Agent AI demands all chip categories simultaneously. But the interesting part is how this ties back to that 99 USD oil.
Oh, you mean the energy cost divergence?
Exactly. High energy costs from the geopolitical conflict really favor fabless designers over foundry operators. Physical foundries just use so much power to actually manufacture the chips.
But is this oligopoly structure blinding us to valuation compression risks? I mean, that risk is being tested right now by Trump's Beijing delegation.
It is, yeah. The delegation has some heavy hitters confirmed. So Elon Musk, Tim Cook, David Solomon, and Larry Fink.
But no Jensen Huang from NVIDIA.
Right, he was explicitly excluded. Now, you definitely want to monitor a potential Boeing 500 jet deal, but the real issue is what Scott Kennedy at CSIS calls the 5B versus 3T agenda.
$5 billion versus $3 trillion. That's a massive standoff.
It is. And Louis Vincent Gave at GavCall Research is warning about a potential structural swap here.
Right, a scenario where China lifts rare earth export controls in exchange for U.S. semiconductor equipment access.
Exactly. The investment implication there is that this swap scenario would just remove the rare earth price floor. That triggers immediate semiconductor pricing pressure and directly threatens that SOX rally.
Wow, okay. And Beijing is already signaling cooperation ahead of this summit through their currency, right?
Yeah, the Yuan just hit a 3-year high. It strengthened to 6.84 per U.S. dollar, and that's supported by their massive structural trade surplus.
And analysts see this trend continuing. Joel Kutecha at Barclays noted that China often nudges its currency stronger right ahead of major summits.
Right, and the forecasts reflect that. JP Morgan is forecasting a rate of 6.50 per U.S. dollar, while Wei Kunshan at BNY forecasts 6.70.
So that's a meaningful FX tailwind for unhedged Chinese assets. But look at the region. While the yuan strengthens, the Korean won is just buckling under that exact regional pressure.
Severely. The won is weakening fast, hitting 1,491 won per $1 US dollar. And when you combine that with imported 99 USD oil inflation...
And President Lee's fiscal expansion rhetoric.
Yeah, exactly. All of that just shattered the ceiling on Korean bonds. The 10-year yield broke 4% for the first time in 2.5 years.
It hit 4.056%, right? That's up 10.6 basis points.
Right. And Yoon Yo Sam at Merit Securities pointed out that government commentary points exclusively towards spending, which really limits bond appeal. Investors just hate unrestricted supply.
Which brings up a big investment implication. The one weakness creates a severe negative carry for foreign fixed income holders.
Exactly. The key threshold for Korean bond stabilization now is seeing the exchange rate fall back below 1,471 per $1 US dollar.
Makes sense. So what do we watch next?
Well, I'll leave you with one last variable. Keep an eye on tomorrow's options expiration. It's going to definitively prove whether the recent KCUS PI sell-off was just a derivatives-driven technical event or the start of a sustained foreign capital exodus.
That's today's AI Prism, Global Investor. This episode was produced with AI assistance based on Seoul Economic Daily reporting and reviewed by a human editor. AI Prism is a Yuan IFRA award-winning series. We'll be back tomorrow.
You've been listening to AI Prism from Seoul Economic Daily.